Good afternoon, everybody. I'm going to go ahead and start right on time, and I'm sure we'll have a lot more people join us throughout the time that we're going to be together this afternoon. And I'll just kind of welcome people in as I see them come in. Just getting started today, this is going to be one of our technical discussions, and it comes out of the appendix of the book that Ben wrote about shadow banking and shadow banking secrets. And so in his book, he has an appendix. I thought I would go through this appendix subject by subject. There's some really good material in here. I'm going to be talking about page 185 through 187 tonight. And we're dealing with the topic of how to take advantage of our debt-backed currency. And so that's really the name of this program tonight. We've got Frenchie joining us. Welcome, Frenchie. And so I would probably mention from a housekeeping standpoint, and I'll mention this again, that the quality of this presentation tonight is going to largely depend on the people that show up and make comments. I'm going to ask a lot of questions, and so I hopefully will get a lot of people jumping in with some answers, with some thoughts, some opinions. And of course, we'll be going over some detailed opinions of the author of Shadow Banking Secrets. And so feel free to unmute your mics, put your smiling face on video so we can see you, and join with the conversation. So again, this is how to take advantage of our debt-backed currency. Before we really get into the shadow banking secrets portion of this discussion, what I'd really like to do is, what I'd really like to do is show you something that I've had for the better part of 20 years, and I've made it available to everyone here tonight. What that is it's a document called Modern Money Mechanics. And I encourage you to get it. The link that I have put into the chat is a link to a free printable copy of Modern Money Mechanics. Now, what's the significance of this Modern Money Mechanics? In fact, I'll show you real quick. I've got my copy right here. I don't know if it'll focus up on anything there in the background's out of focus, but anyway, that's Modern Money Mechanics. It was written by the Federal Reserve Bank of Chicago. So this is one of the regional banks of the Federal Reserve System. And they titled it this, Modern Money Mechanics, a workbook on bank reserves and deposit expansion. Written by the Federal Reserve Bank of Chicago. You can actually write to them and get a copy of this if you want, or you can just go out to Amazon and buy it. You can have a nice bound paperback copy of this workbook. My copy happens to be 52 pages long, and the one that I'm making available here, as you can see on my screenshot, is 40 pages long. So they must have made some revisions over the last 20 years. But I encourage everybody to get a copy of this. And the reason being is because in this Modern Money Mechanics, the Fed itself goes into detail about how they say control the money supply. I'm going to say manipulate the money supply. If you want to know the mechanics of inflation and how inflation works, get this. It's a bit technical, but if you read it slowly and take some notes and write some questions when you don't understand, this is very, very powerful stuff. Because they start out by defining what money is, and then they start defining or discussing about the money supply. You've heard references in the past to the M1 supply, the M2 supply. Those are different definitions of the money supply. And then later on, they go into how money is created. And, you think, it's interesting because we say things about the Fed that are taken so much for granted as being understood. You read The Creature from Jekyll Island, you read other things, and we say things like, well, the Fed just creates money out of thin air. And I'm sure there are a lot of people out there that don't necessarily understand how that works. Well, this modern money mechanics actually teaches you exactly how they do it in their own words. And so, like I said, I encourage you to get this. In this, they define what inflation is, and how through the controlling of the money supply or the manipulation of the money supply, however you want to say that, they then attempt to put controls on inflation and things like that. Another term that we banter around a lot is fractional reserve banking. And a lot of people, again, probably think that we lay people are the ones that come up with this term. So let me read you from the introduction. I'm just going to read you the introduction of the modern money mechanics. And again, as written by the Federal Reserve Bank of Chicago. And this is what they say in their introduction. It says, the purpose of this booklet is to describe the basic process of money creation in a fractional reserve, and they do air quotes, banking system. The approach taken illustrates the changes in bank balance sheets that occur when deposits in banks change as a result of monetary action by the Federal Reserve System. And it's interesting because in these 52 pages or in the 40 pages you're going to be looking at there in your copy, you literally see the accounting that's done by the banking system to illustrate how this money is created, put on a balance sheet. And so, fortunately, being an accountant and one that has spent a lot of time in the banking world, this was pretty easy for me to get my head around. Maybe a little bit tougher for some of you guys, but feel free to ask questions in the community, whatnot. But this essence of this modern money mechanics is what goes right back to what Ben writes about in his book. And so, unless anybody has any comments or questions about modern money mechanics, I'm now going to move over to Ben's book, Shadow Banking Secrets, and we're going to talk about, as I mentioned earlier, how to take advantage of our debt-backed currency. So how many people that are here tonight so far understand what debt-backed currency is? Anybody? Anthony or Frenchie or Carl? Good to see you. Anybody want to take a stab?
Hey there.
what it means to refer to our currency as being debt-backed currency?
It's the same as credit-based, isn't it?
Yes, of course. Mm-hmm. So give us a definition of credit-based currency. How's that? I can phrase it for you in one simple sentence, okay? Every dollar that we have in our economy, every single dollar is borrowed into existence. Okay? You can't look at a $1 bill and say, oh, well, that was somehow printed because we needed more $1 bills. And then look at a $10 bill and say, oh, that one was borrowed into existence. Every single dollar is borrowed into existence. Okay? And so when you look at that fact, then now let's look at the definition of inflation. Anybody want to give me the Econ 101 definition of inflation? Anybody ever take Econ 101? Okay. Well,
it's been a while, but
okay. Well, get some paper out tonight and take some notes so that you can really think about some of these things that we're gonna go over. One thing that I would put on in my note at the top of my page is that link to modern money mechanics. Get that so that, or either open that link now on your browser so you can have it after this meeting, so you can print it out for
Isn't
yourself.
isn't it, I'm trying to remember now, it's a long recall, but isn't it, how do you say it? It's, I can't remember the full definition, but I know it has to do with the price of goods bought and sold.
Okay, you're almost there. You're almost there. You're close.
I know there's more to it, but I
It's a
can't.
very simplistic statement, but when you think about it, you'll get what I mean. The short definition of inflation is too many dollars chasing too few goods. Too
All
many
right,
dollars chasing too few goods.
all right, close. That was close.
You're very close. Okay, that's the definition of inflation. And a lot of people either unwittingly or deliberately, depending on who you are, misdefine inflation. Okay, and they try to attribute inflation to things that have no control over inflation. Again, when you're thinking too many dollars chasing too few goods, you combine that with what I said earlier, the maxim that I stated earlier, which is every dollar is borrowed into existence. Okay, so when you think about that, too many dollars chasing too few goods, and every dollar is borrowed into existence, then what is the major contributing factor to inflation? Take those two
Well,
statements.
you just said it. You just said it, didn't you? You said it. Too many
Almost. The cause of inflation is borrowing. Every dollar is borrowed into existence. And so if every dollar is borrowed into existence and inflation is defined as too many dollars chasing too few goods, then the definition, or the key cause of inflation, I should say, the cause of inflation is borrowing. Now, that's your credit-based currency, or your debt-backed currency. Now, if you want to have some fun with this, and I don't mean to get a little political, but you got to have some fun with the doddering old fool. He said the other day that conservatives were responsible for inflation. Oh, really? So what's inflation? Too many dollars chasing too few goods. How could conservatives create the dollars that are chasing too few goods? Or I have a more fun one. This one's even better. A couple of months back, the doddering old fool said Putin was responsible for inflation. Okay. So does that mean that Putin is running our Federal Reserve? Is he the one running the printing press? Is he the one borrowing the money into existence? You get the absurdity of some of these political sound bites. And the sad thing is either he knows that he's deceiving the people, or he's insulting our intelligence. He thinks we're too stupid to figure it out, and so he's insulting our intelligence. But anyway, I just wanted to get a couple of bumper stickers out there and let you see that when they put things on like that on bumper stickers or sound bites, how they are truly lying to the American people. And what's particularly funny about it is that most people know they're lying, but yet we continue to pretend to believe what they pretend to tell us. But anyway, I wanted everybody to understand that that's the definition of inflation and the cause of inflation. Okay, so what are some symptoms of inflation? And again, I'm making a point that's going to get us right back into shadow banking secrets here. But what are some of the symptoms of inflation? If you try to measure inflation, what do you measure it against? Let's start with that one.
Supply and demand.
Okay, that is another economic reality, but we're focusing more on the supply and demand of money itself. So how do you measure inflation, because a lot of people talk about inflation as a rate, a certain percentage. Okay, and so, and they call that inflation. You know, we have so far this year, I don't remember what the exact number is, 8.3% inflation. Okay, and some are obviously, some sectors are much higher than that, and others are lower. But overall, we have this 8.3%, right? What's 8.3%? Is that inflation? Or is that an inflation rate? You see the difference? If inflation is defined as too many dollars chasing too few goods, then the percentage of inflation growth, or the inflation rate, is that percent that we quote. It's often quoted in financial circles as the consumer price index, or CPI, right? Because it's a rate of inflation. And so I want you to be able to, if you've gotten your notebooks out and you're kind of taking some notes, I wanted you to be able to put that down and take a look at that, because you know, the next time you're in a conversation around a meal, you know, having drinks and beers and or, you know, sipping on wine with your intellectual buddies, and they talk about inflation being Putin's fault, or they talk about inflation being the fault of those greedy unions, or inflation being the fault of those greedy convenience stores that sell gasoline at inflated prices, right? You can come back and you can say, let's define some terms, okay? And you're taking these terms right out of Econ 101, and you're taking them right out of Shadow Banker's Secrets, because Ben teaches a big dose of Econ 101 in all of this. So now that we've kind of had a brief tutorial on inflation, what it is, how it grows, what's the cause, what's not the cause, Ben starts out this section of how to take advantage of our debt-backed currency with this question. Okay, and so get ready, see if you can come up with an answer for this. The interviewer asks, how should the retail and consumer channels use the knowledge that our money supply is actually tied to the total amount of bank-issued debt versus the total value of goods and services? Okay. How should the retail and consumer channels, that's us as consumers, before you talk to us as shadow bankers, but us as consumers, how should we use that knowledge that our money supply is actually tied to bank-issued debt as opposed to goods and services? By the way, what are goods and services tied to? I should ask that question as a sidebar question before we go into this, so that you can kind of, like I said, I'm laying the foundation for you to understand the answers to this question. Ben gives many answers. So what would you tie the value of goods and services to? Would you tie it to inflation? Would you tie it to debt? Or would you tie the value of goods and services to something else, if we were looking at it from an economic standpoint? Anybody want to take a stab at that one? Just for discussion purposes, I'd toss out the term GDP, gross domestic product, you know, or gross national product. I don't know if those are two different measurements or they're basically defining one and the same, but they represent the sum total of all the goods and services produced during that particular period being measured. So you could look at GDP on an annual basis, you could look at it on a quarterly basis or monthly basis. I suppose you could break it down and look at it literally on a day-to-day basis, if somebody was actually measuring it. But that's what the total value of goods and services are linked to, is the sum of all of that is gross domestic product. Okay. And so, you know, if we had an asset-backed economy or asset-backed currency, I mean, you know, you could have any numbers at different things back your currency in terms of assets. We've had gold in the past, obviously that's a no-brainer, that's historic. I remember golly, 30, 40 years ago. I don't remember if you guys were around then, but there was a goofball named Lyndon LaRouche who was always, and I call him a goofball because he had some whacked out ideas, but politically speaking, but economically, he wanted an asset-backed currency and believed that if we took all of the infrastructure assets that we have, railroads, freeways, bridges, all of our infrastructure, and turned it into a big giant asset, that we could then develop a currency, asset-backed currency based on that. And so, like I said, I don't know how realistic that really was. It always sounded good when he said it fast. But there's an example of potentially what could work as an asset-backed currency. I don't know why he ran as a Democrat. I wouldn't support him, but he was a little on the, I think, on the socialist side, and just kind of a real hodgepodge of political ideas, and some of them, like I said, were kind of out there. But it's an example of an asset-backed currency. I suppose you could come up with any number of other asset-backed currencies, but the key here is to recognize that we are a debt-backed currency, and every unit of our currency, every dollar, is borrowed into existence. Okay, with that, let's go to Ben's answer. So the question is how should we use the knowledge that our money is actually tied to a debt-based or bank-issued debt versus the total value of goods and services? Okay, so that's really the overarching question. Ben starts out by talking about how there's a lot that can be done, where he says, I don't know that there's a lot that can be done specifically in terms of managing that relationship. In other words, he starts out by saying, essentially, the system is what it is, and there's not a whole lot that we as individuals can do to change that, but we can take advantage of the system to our benefit if we know how to do that. And that's kind of what he's starting to refer to. Again, just by way of housekeeping, if you guys have some thoughts or ideas that you want to comment on with respect to some of the questions I ask, or the rhetorical questions I ask, or even the comments I'm making as I review some of the material in the book, feel free to just unmute yourself. Hey, Toby, unmute yourself and go for it. I will stop and just let you run with the mic. So feel free. Toby, did you have something you wanted to say there?
Nope, not yet.
Okay, all right. So I don't know when you came in, but I put a link to this Modern Money Mechanics in the chat. So feel free to open that up. This was actually published by the Chicago, or I should say the Federal Reserve Bank of Chicago, one of the regional banks of the Federal Reserve. And it goes into detail in terms of how they create money from nothing using fractional reserve banking principles. And they talk about all of that, how it actually works. So enjoy that. That's my gift to everybody tonight. So Ben starts out by talking about how there's some fundamental principles that apply to what we're talking about here. And of course, a lot of people, when they come to the realization that markets are manipulated, the currency is manipulated, and all of that kind of stuff, they then try to flee to safe havens like gold or real estate. And he mentions that even though those are really good safe havens and all, timing is another issue that you have to take into consideration when investing. And he mentions specifically, as the old adage goes, he says the market can remain irrational longer than you can stay solvent. In other words, you may put your money into that gold or that real estate, and if you don't do it properly, then you find yourself buying and holding, and those things, even though principally they're correct as but alternatives that you can move your money to, you could be waiting a long time for movement of price movement. And so that's why he says the market can remain irrational longer than you can stay solvent. He goes on to say, we've seen gold interest be crushed for years and stuff like that. And I totally get what he's saying. I mean, right now I'm playing with some gold instruments, and I'm sitting here kind of getting nervous because they were supposed to move by now and they're not moving yet, and so I may lose that position. And so he says it's not a simple answer here when we're talking about taking advantage of debt-backed currency, but it's an important point to drive home. There are things that you can do. So anybody want to hazard a guess or a statement as to what you think would be some good alternatives to the debt-backed currency as far as how to invest that and be successful? Ben lists one. I'm just wondering if you guys have had a chance to either read it or are familiar with what he's talking about.
Well, you mentioned real estate.
Yep, that's a good
That's
one.
what I was thinking.
In fact, the big lesson that Ben talks about that that he learned through the 2008 crisis, or I should say going into the 2008 crisis. Remember he started out wanting to invest in real estate and then quickly learned that he could do better, make more money, do better, be more successful by lending. And that's where things really took off. Carl, were you with Ben back in that day? Can you speak to some of that discovery?
Yeah, I was, and I think that essentially the premise of that, without having Ben's book in front of me and having not read it in a while, and also having a toddler occasionally running by to kick me, I'll do as well as I can. Yeah, the underpinning, I think, of that, if I were just going to summarize it, is when you lend, particularly against real estate, you're adding an additional layer of security and also potentially securitization, right? So you're insulating yourself from certain risks by just risk is kind of like matter. You can't destroy it. You can just displace it, and spread it. And that's essentially how Ben and I got involved together. Like myself coming from more of a traditional finance background, and Ben being a real estate investor previously, and he'd seen some of this firsthand, and I had experienced kind of the same theory on a more institutional level, and how we started out was really trying to bring some of those same principles of decreasing our risk exposure while still getting the upside exposure of real estate. And the way we did that was through, and I don't know how much you want to get into just something anecdotal like this, but the way we did that was through a very strict underwriting process where we loaned to kind of primarily residential mortgages, but to investors, right? I mean, we're talking about residential properties owned by investors, and the problem that those investors face always was access to liquidity. We were able to offer them faster access to liquidity, and typically not quite as loan shark type interest rates, because we would underwrite only loans where the underlying property essentially would allow us to absorb, I believe our exact terms were somewhere around a 25 or 30% drawdown in
Mhm.
the market. So essentially, we knew there was that much equity sitting in whatever we loaned against, right? That we could that we would be covered against that much of a drawdown. So, and even if that happens, right? If your investor or / borrower, right, defaults, then it all becomes upside. The equity that was in there. So it's a little bit of a windfall. Like everything is great if they pay the loan. If they don't, even better.
Mhm.
If that makes
Right,
sense.
right. So I've got this burning question I've got to ask you. Toby and I have talked about this for months, and some other folks, and there's some people here in the group that I know are excited about putting together some real estate funds, and so or debt, fixed income funds based on debt, like what you guys did. And so I've got to ask this question. I know that in the book, Ben, essentially steers everybody away from this concept of LTV, which is what so many traditional lenders go for. He also sets the stage by saying, we looked at the disproportionate or the breakaway from the correlation between rents and home prices, and focused on a model that was based more on a net income model rather than the traditional LTV. And so the question came out, okay, so that's kind of in concept what you've done. What did you actually do? Did you take a net income on the property, based on these single family homes, and determine what an appropriate net income would be, and then do some kind of multiplier based on that to come up with your loan value, the loan amount?
So I got to be honest. Ben Ben underwrote this stuff and underwrote the strategy. I was a little more tactical. That and as you can tell by he wrote this book, not me, right?
Uh-huh.
He is the mastermind of that. You know, it's an approach that's not altogether different than like the term cap rate that
Mhm.
I think that you hear
Okay.
people use a lot.
Right.
And that's also kind of why real estate is sort of shit right now,
Mhm.
just
Yeah.
directly. But you know, so
It
it
sounds
is
like he came to a conclusion about the quote cap rate, though, based on a different criteria than the traditional cap. And that's why he was able to succeed so well.
right. See, now I think you're getting too into the minutia for me to
Oh,
speak
okay. Sorry, I
directly
didn't
to.
want to put you on the
Like
spot.
I don't want to put words into Ben's mouth. And,
Heck, I do that all the time.
no, yeah, that's. But I'm planning on moving next door to him, so it's going to be a problem. So yeah, look, and it's been a while since we were engaged in that regularly, and also,
Mhm.
like I said, I was telling I'm bound to distraction here
Okay.
with the baby.
Well,
She's
I don't want to
waiting.
put you on the spot, so that's
She's
okay.
yeah. I'm sorry.
Oh no, you're fine. You're fine.
This is the time the baby goes to bed at 7, so I'm just trying to like balance everything
Okay.
here. She likes to have a little hug time with dad.
Sure, you
I
bet.
apologize.
No,
Um,
I'm a dad and a grandpa myself. I know exactly how it works.
I tell you what, I will make sure that I corner Ben into some time for all of us to talk about that.
Okay. I don't want him to give
And-
away anything that he considers proprietary or anything like that either. But we just
Well,
figured
yeah.
it's been so long ago. I just was,
So
that's a question that I often get.
yeah, I understood, and but there are elements of it that you bring up a good point, and you said it better than I did. So I might have been playing dumb more than I should have when it's really I just shouldn't talk about it too much
Okay.
because
All right.
there are some elements of that are being done elsewhere, and I'm just not sure what I should share.
Okay.
So again,
Okay. Fair enough.
it's not like it's not I don't think it's anything that someone couldn't figure out, but
Okay.
I just don't want to share it.
Well, you've given us a lot of good meat to chew on for a while, for another month or two, as we're trying to get our head around that. But no, thank you.
Okay.
Um,
Well,
My point.
so Eva wants to say hi. So
Okay.
we'll say hi. You say,
Hi there, baby.
say hi. Can you see her?
Oh yeah, we can see
Yeah.
you both.
All right. All right. Yeah.
Yeah,
We
Toby's now
we
getting
are,
on screen so he can wave.
all right.
Frenchie and
There we
Tony,
go.
Anthony. Yeah, if you guys
All right.
come on there and
Say
wave.
hi,
you can
Eva.
see- There's Anthony. He's waving.
There
Okay,
you
so
go.
he's got just about everybody. There they are. They're all waving at him now.
Frenchie, Anthony, Toby.
Great.
All right.
So
Okay.
you know
Can we
what's
go?
really
Can we
good
go to mom
though,
now?
and Carl, I do appreciate you taking the time to answer that, because it allows us to segue back into what Ben wrote about this, and that is that the whole idea of doing convertible fixed income for a fund strategy is a business in and of itself. He says, and so yeah, I could understand why there's some proprietary stuff there, and it takes a degree of expertise and structure and knowledge and understanding, probably more than I
Yeah.
have, because I'm not a real
Well,
estate.
it's also what worked then doesn't necessarily work now.
True.
True. That so it's not a blueprint. And I think that's kind of the value of the Ben's book and the concepts that he's trying to relate. He's not trying to give you a blueprint. He's trying to give you a set of analytical tools and education where you can formulate what works for you, right? Your expertise.
Right.
So, like for me, I haven't been active in the real estate space at all because, like, I found a sweet spot where I found small and medium cap like private companies that I had a little bit more of a knack for discovering and creating value in that space. So that's been what worked for me.
Yeah.
And I find that is actually and part of my getting more involved with Adagio again is like the stars kind of aligned there, and Ben's thoughts around what works right now is kind of come back into we have more of an overlap on the Venn diagram of where we think things are going. And with a lot of the, let's just call it macroeconomic factors and the idiosyncratic risk that's in the market right now. She's not happy that mom took her. Anyway, she really liked you guys, I guess. Yeah, with all of that, I think one of the best ways that you can at least cover your ass a little better than like what does Ben say, Joe the garbage man or whatever, right?
Yeah.
Like you don't want to just invest like the everyday guy, the know nothing. You don't want to be dumb money, right? So one of the best ways to avoid being dumb money is like if you can find these sort of niche businesses that generate consistent flows of income, which that's the beauty of like real estate, right? People are like, oh well, I can generate income from this. Well, if you can create like creative deal structures around like acquiring successful businesses that have consistent cash flow, you have some inherent inflation safeguards in there just because you're you're turning over cash regularly, and yeah, your supplies go up, but you're able to raise prices because everyone's raising prices, and if there are just a lot of kind of localized markets for things that don't operate as efficiently as possible. This is a stupid one, right? This isn't something that we invest in institutionally, but you just think about, for instance, like a maid service. If you
Mhm.
thought, well, I want to start a maid service, right? I'm going to invest in that. Well, just, getting your wife or your kids or whatever to clean houses, that's not a very profitable venture, right?
Mm.
But if you like build a marketing infrastructure up and a brand, and then you go out and subcontract people that are already in the house cleaning service, right? And you're handling all of the incoming calls and routing them to your pre-vetted service providers, then you actually could wind up a business like and ramp it up pretty quickly, like
Mhm.
doing something like that with
Right.
without a lot of cash outlay.
Right.
It's just a lot of legwork, right? You just have to,
Mhm.
but it doesn't require a lot of money. It requires like a lot of know-how,
Right.
and not about cleaning, but about running a
Marketing.
company
Yeah.
and
Marketing.
marketing,
Sales.
right?
Mhm. Yeah. No, those are really good
So,
points.
and I don't know if that's super topical, but that's just I'm just throwing out an example there of why. So I'll speak for me and not necessarily include Ben. Why I feel so strongly about like localized small and medium businesses right now.
Mhm. Private
As
equity,
far as
basically.
exactly, yep. But
Okay.
not necessarily at the same level that the massive private equity funds do it.
Mhm.
I think that because at that point in time, they're talking about like their exit strategies are oftentimes like going public, things like that.
Mhm.
And we're talking about um, an exit strategy where you roll up $2 million, $3 million, $5 million companies and uh, brand them consistently, put a good corporate infrastructure around them, and then you make your money from selling it to the Cerberus, right, or
Mhm.
whomever, whatever, Vista Partners, one of the big boy private equity firms, and
Mhm.
let them take it from there.
Have you explored the benefits, tax and otherwise, of selling those businesses as opposed to the big boys flipping them over to the employees and making an employee-owned business?
Have I?
Yeah,
No, no.
I was just curious if that was a
I-
viable
aren't you a CPA?
source.
Shouldn't that be your thing?
What's that?
I said, aren't you a CPA?
Yeah, I am. I'm retired,
Right.
but
I was
yeah.
gonna say, yeah, you know more about that than me.
Okay. I was just curious
So,
as a possible steady stream of buyers for your private equity once once you beefed them up and you're ready to do your exit, if you'd actually looked into an ESOP as opposed to just looking for a big uh, fund to buy them out from.
yeah, I think that I came across that one time a very long time ago that it was floated, and you're gonna correct me because I'm probably all wrong, but it was like we had an S corp that we were dealing with that we were trying to do a recap for, and because they had gone into like they defaulted on some terms
Mhm.
for their existing lenders, and it was like I don't know if you guys are familiar with Wells Fargo, it was like and but they had some predatory lending terms even in their commercial arm.
I defended a client once about 20 years ago in a $54 million lawsuit against Wells Fargo. Bad bank.
Yeah, they don't play nice. So
No,
we were
they
we were
don't.
trying to like we were trying to basically fix the entire capital structure. And the only way that it was going to be viable was to get out of those out of the basically the penalty clause, right? So it's like even if you're paying, if you violate covenants, you're just getting smashed
Yeah.
with the interest rate increases. And one of the things we looked at was selling part of the company, but it had been structured as an S corp, and we were going to trigger all sorts of tax liability, if I'm remembering the exact situation correctly. Like I might be a little fuzzy on some of the facts. I'm digging way back in on that one, but yeah, it was a mess, right? I think somehow, like I said, you're the CPA. I forget the exact reason, but I think somehow with the S corp, if you don't do some things, then when you try to sell equity like that some other way, you can, I guess, be forced to recognize what at that point was kind of gains that weren't
I was gonna
really
say your
there
capital
anymore.
gains. Yeah.
Yeah,
Yeah. And
something
if
like
it's a
that.
non-cash transaction and you're now forced to recognize a taxable event, that can get pretty painful real fast.
There you go. That sounds about right. I knew I was on to something. I was like, I'm not making this up. I just can't remember the details.
Yeah. But it's funny, you mentioned Wells Fargo, and the cartoon that comes to my mind in our situation, and you can probably laugh at this, but you remember that old cartoon you see hanging up around offices where you got the stork swallowing the frog, and the frog has his hands around the stork's throat?
His neck, yeah.
Yeah.
I said, that was our case exactly. And we held on like that until Wells Fargo finally said, okay, let's negotiate a settlement.
Yeah.
It was pretty funny.
That's exactly what they do, right? They try to swallow you.
Hey, Carl,
Yeah, force you to. Yeah.
going back to your cleaners example, that kind of gave me a thought. What about acquiring these short-term rentals in markets where they've changed the restrictions for short-term rentals, if we have a way of getting around those restrictions?
So, for example, so they've made it more onerous. Is that what you're saying? To have
Yeah,
a short-term rental?
so what I'm thinking is, I think there's something going on in Atlanta right now. And they just make it more difficult. So what I'm seeing is maybe, or thinking is maybe a lot of these short-term rental owners, they've got a choice. They can either do long-term now, or they can just get out of the business, because a lot of them may not cash flow long-term. And so there might be
Right.
some opportunities for just buying the properties with all the furniture in them and taking that over. Because we have a way of
Yeah.
getting around those regulations that they may not
Like
be
I-
aware of.
So again, real estate is not my sweet spot, and I certainly wouldn't want to tell you like definitively. So my fear with everything, I think, applies also to the short-term rental market, regardless of like kind of the governmental limitations that or obstacles that might be there. I think that you also have just the obstacle of when the economy's down, you don't have as many travelers. And I don't think we've actually, now also not an economist, right? Was trained as a lawyer, which is why I caveat everything.
No, understood.
But yeah, I think my belief is we haven't really felt the pain that we're gonna feel, like as in the on the whole in the economy yet.
Oh,
I think that that's coming like next year, and I would be hesitant to like hold the bag on a lot of this. I mean, if you did it for like nothing down, owner finance notes, whatever, like fine, sure, maybe that's nothing. But I wouldn't. Geez, sorry guys. But yeah, I wouldn't want to put too much like equity into something like that unless you just had it backstopped by a ton of money, and then I wouldn't think that's a very efficient use of your capital.
Yeah.
Like to just have it sitting there.
So that brings up two thoughts. One, I could just wait for that event or wait for that pain to be at the peak. And then now you're getting them not only with the restrictions, but the property value is dropping. So you pick them up for pennies on the dollar.
Yeah.
Two, there's also what's called rental arbitrage, where you're not even the owner of the property. You just,
Yeah.
take it over and,
I-
and you're just collecting the cash flow. And then you have that
I-
opportunity because you're in a position to
think-
buy it.
Yeah, I think JoJo and Jordan from The Bachelor do that.
Oh, yeah.
Jordan Rogers, I don't know if you remember him. He played quarterback at Vanderbilt, and his brother is Aaron Rodgers. But he was like on The Bachelor, and I only know this because I randomly ran into this show on CNBC. They had, which basically that's what they do. They go in and it's not exactly what you were talking about, but their whole short-term rental market play is to pay for the renovations. So they are, taking on some initial capital outlay to improve, renovate the property, and brand it with their brand, do all their design, and they take like a 2-year lease and agree to pay a fixed income of like $700 to the property owner, right? And then
Yeah.
so everything that they make once they recoup their initial investment and cover the kind of their master rental agreement is profit. So it's just similar idea.
Mhm. Yeah.
I actually thought it was pretty interesting when I saw it. Again, it has some of the problems of because they are the only thing they're avoiding in that instance is potential depreciation, right, of the property.
Yeah.
And I mean, I don't know for an everyday person that doesn't have like the hundreds of or tens of millions of capital that they've made from another business, like it probably isn't that viable. Because if you were going to do that, right, you would have taken into consideration like if it's like a pool house that they're using, or like a dedicated apartment within the same structure. Like you have to spend a lot on ensuring sort of where your lien position was in all of it. Because if they just stop paying their mortgage, then everything goes bad. You would lose everything. But I mean, that's not at all what you're talking about. So I
Well,
digress.
in a way, yeah, because I would want like a first right if they decided to sell it or stop making the payment, that we could buy it at property at the appraised value at that time of the property, not of the business, because it's the business generating capital. But as we'd have the first right of refusal to purchase that, so we'd be in that position when that if that happened.
So
Right.
let me jump back in here because we're getting close to the top of the hour, and I want to touch on a few key points just to round out the discussion for tonight's topic. But to segue back, I want to acknowledge what you've been talking about, Carl and Toby both, with a comment that Ben makes here in the book. In fact, it goes back to my original question. It says, basically, he says, for example, and this is about real estate now and lending in particular. For example, people have to understand how to value real estate through the lens of net operating income. And again, that kind of is where we jumped off. And so I'm bringing it back to that point where, he talks about how he tracked income from property or rents from property as against a correlation of property sales prices. And back in just prior to 2008, he was watching this divergence. Remember that graph that showed that prices were becoming disconnected from rents, and so that was his key, his secret to coming up with the methodology that Carl has now acknowledged is probably proprietary, but that's okay.
If Carl is at least acknowledging if he tried to explain it to you, he would either be in trouble or do it wrong.
Yeah, I understand that. I've put myself in a few positions like that over the months. It's all good.
All right.
So
as long as everybody's got the understanding, we're all on the same page.
Yep, we're all on the
Go
same
ahead.
page, and we take it all with a big grain of salt. The important thing is the principles that we discuss from the book, and somehow apply those principles to actual examples and things like that. So jumping back in here, I want to just quote him from a couple of places, and then we can comment on these. He says, the idea here is to express that, yes, there are fundamental structural problems with the nature of our debt-backed currency. And there are things that can be done, but they're not simple, okay? And so, or they may be simple in concept, but they may be more challenging in their implementation. And of course, what he's really leading down to here is the thing that we've talked about many, many times over the last 6, 7, 8 months. And that is, it's why he put all this together, so that he could help introduce people to, help train people in the formation of how to set up funds, become asset managers, become fund managers of our own funds, as a way to funnel capital through the process to asset managers who are running these alternative assets, these structured products that Ben designs and so forth. And so we've all kind of come at this from our own unique interests. I know there's some people that are interested in real estate, others are private equity. I personally like the markets, and so I'm looking at doing a hedge fund of some kind. And we're playing with a real estate product that we're looking to roll out. And there's a lot of different things that we're looking to do. And the exciting thing is, guys, and I end up saying this every single time, but this is the secret to taking control of our lives and taking control of our businesses in such a way that what's happening to the economy. And I picked on inflation a lot tonight, but people are very concerned about inflation. They're concerned about energy prices skyrocketing. They're concerned about a lot of things, and a lot of people are in a state of fear. And what's really cool is you've got Ben here, this lone voice in the blizzard, saying, "Hey, there is a solution. It may not be easy, but it is a great solution, and it will help you transcend the issues that we're talking about." It's what BlackRock did when they were dinky and just starting out back there in 1988 or 89, when Larry Fink was getting started. And it's fun because I've studied a little bit about what he's done over the first decade or so of their existence. And Adagio is doing some very similar things, particularly in the area of managing risk. And so that's the key. Just going back here, we all know that there's a lot of good projects out there, worthy projects. He mentions Mother Teresa. He mentions, some people that are doing some great things. And we have an individual in our community here who she's all about doing humanitarian projects of a honor, a great work. We're talking about, the wounded warriors. We're talking about, curbing human trafficking and education, and some really worthy causes. And that's what she's doing, is she's recognizing that putting funds together that are dedicated to those purposes, and how to structure those and dedicate them to those purposes, are the key to funding those causes that she feels so passionately about. And you're all going to feel that way about certain things. Making money is just a means to an end. And so Ben points that out. And again, he also points out that then doing your own fund is the key to making that good in the world happen. So I just wanted to mention that again. Again, he mentions that he says, the reason I say is that I want to motivate people to take a deeper dive and that is that 99% of the people I come across who are aware of these things, we're talking about aware of the problems in the world, the economic problems that impact people's lives so much. People tend, he's talking about, I mean, the deep-seated, I'm quoting him here, and I mean the deep-seated corruption by the banking cartel. Okay, so this is going back Jekyll Island. This is the modern money mechanics that I just introduced you to tonight. That is the essence of the banking cartels right there. I mean, the name of the game is bailout. That's how they do the self-serving use of the money, but they create it this way. And they also use it to create through the bailout process too. So anyway, he's just saying, don't fall into the trap of saying there's nothing we can do about it, so why bother, right? Really get into this, understand what it's going to take to get your fund up and running, and we've boiled it down to some simple conceptual steps. So, look at those again. I'm talking about our fund launch formula that we've plagiarized with impunity.
Mm-hmm.
And that's okay. And, Ben talks about here, through this process, he's providing the solutions to escape the shackles and achieve true and absolute freedom. And that speaks to my heart. He goes on to warn, though, that finance is a sophisticated business. The corruption and dysfunction are the things that are the most cancerous and pervasive and complex problems the world faces, right? And he's not exaggerating. I mean, if you look about, if you go back, Clinton ran on the bumper sticker slogan of "It's the economy, stupid," and he was right. Nothing probably impacts our lives so directly and so deeply than how we are impacted by the economy. At least here in this mortal sphere. And so, he says the first step to doing something about this is to understand the roles in the financial industry. Again, understand the roles of the bank. Go back and rewatch our archived meeting about consumers, producers, and bankers. Oh my, it's there in the community page, but that identifies, again, some of these things that we're talking about. A lot of this appendix material is designed to create the why we're doing this. And so I encourage you guys to go read that. Go back and review some of those videos there that we talk about that, so you can kind of get your head around why you're doing this and why you feel so passionately about it. He says it all starts with an understanding of the repercussions of being dependent on a debt-backed currency. And when I read that, I went back to his original slogan, I think there in chapter 1 or 2 of the book, where he talked about, he rephrased the golden rule, if you remember. It's not the one who has the gold makes the rules, it's the one who understands the most about money that makes the rules. And so this all kind of brings it all together that way. And so, you got two paths, and I know all of us here are probably on the second path, but the first path, you can use this to better understand how your professional investment advisor should be working with you, or you can fire that person and find somebody who understands it in the context of what we're doing, right? And then the second, of course, is do what we're doing, which is organizing, setting up, creating these funds, and doing it in such a way that we can then function very closely with Adagio, with Ben, and have that working relationship. And I guess I would close with just one statement that he has made to me personally. Toby, you might have been there. You might have been there when he said this. But I want to reinforce where his mind is at with respect to us. We are his avatars with respect to why he put this business together in the first place, this institute, to educate us and bring us up to speed on this. He's not looking for students. That's what he told me. He said, Mark, I'm not looking for students. He goes, I'm looking for peers. I'm looking for colleagues. And if I've got to create them, then that's fine. I'll create them. But don't look at me as your teacher and student relationship. Get to where you need to be as fast as you can so we can work peer to peer. Kind of like Carl and Ben work together. And so that's our goal. That's what we're getting to. And some of us are moving very quickly in that direction. And I'm pleased to say, I'm happy to say that with the feedback I'm getting from Ben, I'm moving in that direction. I'm glad to be doing so. I know some of you guys are too. So anyway, that's about all I have to share tonight with how we are working within a debt-backed currency economy. Anybody have any final thoughts that they want to add or comment on? Well, come on, I didn't do that good a job.
You've enlightened us, Mark.
How's that? What was that? You both came at once. Toby, you first.
I said, you've enlightened us.
Oh, okay. Anthony, what were you saying?
I just had a question, just because I've been looking at different strategies and I didn't know if Ben had a promissory note strategy that we could set up a fund to invest in his promissory notes, since he's lending on real estate. For like,
I haven't heard that one. That's an interesting concept.
well,
You're talking about basically factoring notes of some kind?
No. So it's real simple. So I found some promissory notes that will pay, let's see. So here's one. A 3-year promissory note will pay 15% interest every year, and it's paid monthly. And then they'll also give a 5% bonus if you have more than 200,000 for the investment. So what I'm thinking is I'll create a fund that will invest in promissory notes like that. And let's just say I can get my client 6%. I would offer my client 6%. And then of course I would keep the difference made on the money. Real simple, real easy. I just didn't know if he had anything like that, what we could invest in, because it'd be a fixed rate. We know what it's going to be year after year. And that's typically what my clients are used to. And a lot of them that are coming out of the market, they want something that's a for sure bet and a guarantee interest that they're going to get. I mean, it's not guaranteed because of security, but
sure,
more guaranteed.
I would ask Ben that question in the community. I would direct a comment in the community to him, at Ben Summers, and ask him that question. But keep in mind, here's what he's going to push back on. So do some homework on this. He's going to ask about the risk-adjusted performance measures with respect to these. In other words, how do you do some rigorous back testing? How might you do that? How might you apply some analysis, some risk-adjusted performance analysis to the kinds of returns that you would expect to get on this? He himself, there's two ways to approach it. We're doing this ourselves right now. I'm working on a project with Toby, in fact, on this, where I asked about back testing. I asked about the risk-adjusted performance measurements and metrics, and he basically said, well, I can do it for a fee, or you can do it, okay? And so, I literally got the book out, went to a couple of different pages in the book and said, okay, I can set up spreadsheets that will allow me to complete the analysis, provided I get a good data set that, allows me to go back over time. Remember, you got to go back to pre-2007, 2005. I actually collected 43 years worth of data. So I knew that it was going way back. It goes back past the 2008 crisis. It goes back past the dot-com crisis. It goes back past 92. It goes back past 89 when we had Black Monday. It goes all the way back to the Jimmy Carter days of inflation. Okay, so I knew I was getting a dang good data set. and then I did all the testing on it. Just about done with it. So if you're a little bit of a spreadsheet guru, and you can look at, I mean, he puts the formulas right there. In fact, I can tell you what pages in the book they're on, because I've now got them hard.
Yeah. I've seen that, and he offers that for sale for like, I think $700 a month or something like
Yeah.
that. It's kind of
So
expensive,
it's
but
page 79 and page 92. Okay, 92 has the same measurements as page 79, but page 79 has 14 more measurements, starting with the Modigliani and going through the omega ratio and the trainer ratio, information ratios, and R squared and those kinds of things. And so I'm literally doing that myself with the idea that I'm hoping that Ben will take a look at that and basically grade my paper and say, yep, you did it, you got it, or no, tweak this or tweak that.
well, the company that I just mentioned, they've been around for at least 20 plus years. So, I mean, how would that factor in?
Well, you'd get 20 years worth of data on their return. I would start by looking at how profitable they've been year over year, going back 20 years. Start with, 2002. What was their return? What was their profit margin? You can pick EBITDA, you can pick net income, whatever you want to do, but pick a profit statistic and then follow that up, 2002, 2003, 2004, all the way to today, right? Now you've got a data set that goes back further than the minimum that Ben recommends, right? He recommends you go back to 2007 or 2005, I don't remember, but you're going back before 2005, so you're good, right? And then start that process and then go back to page 79 and 92 in your book, and all the formulas are there that you build into your analysis. He's got formulas right there on those pages, and you can build your own spreadsheet right there.
So would I input the offer that I would be making to my clients, or do I put in the offer that they are making to me?
Well, right now, you just want to see if it's a good idea, right? So I just focus on net profit, one of your profitability measurements, EBITDA or net profit after taxes, whatever you want to do there. Pick a number that is consistent so that your database is consistent for the 20 years. And that's a good data set. Do your analysis and then see what it tells you at that point. Now, after you've done that, you want to look at the deal you want to offer people and go, okay, can I offer them a deal and still make the risk-adjusted performance returns that I'm hoping to make?
Does he have a trial for that program, for that app?
What's that?
I said, does he have a trial program for that app?
I have no idea. You'd have to talk to him about that. Like I said, when he and I talked, he just kind of laughed and said, you can do this yourself, Mark. He goes, you're bright enough. You can figure it out.
Yeah,
I did.
yeah. I will have to contact somebody on Upwork or something like that, because I'm not too good with Excel. So
yeah. Oh yeah, you can find some Excel guru who's willing to do it on the cheap. Somebody from India or the Philippines speaks good English.
Yeah. Okay.
Pay them $50, pay them $100, and they'll do it for you.
Okay.
So sorry,
Yeah, Carl.
Is it Anthony? No,
Yeah.
Is it Anthony?
Yeah.
Sorry, this is my first time in here with you guys. So so what's your background? Just out of curiosity. Trying to get to know people a little bit.
Right. Yeah. I've been in sales my whole entire life. I mostly sell annuities right now, which, they're paying better than bank CDs. But I know that there are, promissory notes out there paying 15, 20%, where I know I can make 10% on somebody else's money. So it's just common sense for me to kind of go that way and make it easy for myself. But I've been in insurance sales for at least 6 years. But I've been in financial services longer than 10 years. So I do have a sales background.
Okay. Well, yeah, I mean, I would encourage you probably to, I mean, you don't have to give away the whole farm, so to speak, on school or whatever, but I would post there and get feedback, and start a conversation with Ben. I presume if you've taken the course, then maybe you've had access to a strategy call or something with Ben. But if not, you might be able to finagle one out of him, at least 15 minutes or something. With the if you frame it properly, he might be intrigued. I mean, I know I'm interested to hear. Mostly, if anything, is like what sort of company is giving promissory notes like that? Like, holy crap!
Well, I mean, yeah, they're invested in real estate. They have other businesses. I think they buy businesses too. They do a lot of different things, but they've been around 20 years, man. So, and I found them. I was like,
Yeah.
oh crap, I need this.
If
This is what
if
I
I
need.
understand correctly, what they're doing is they're discounting, when they buy the promissory note, they discount it. And then the holder of the note takes a discounted price in order to get all their cash up front. And now you're getting the payments, and you're making money in two ways. You're collecting the interest on the note, but you've also made money based on the discount that you paid for that note. Is that correct? Is that basic? Did I characterize that correctly?
I may not be able to keep up with all of the jargon, but they're offering 15%, and then I would offer my clients 6%, and I would just keep what's in between.
Right. But I mean, when they say offer 15%, they're basically taking a 100, say the note's $100,000, right? Somebody's going to pay $100,000 over the next 10 years. And so they've calculated an interest rate in there. There's a monthly payment or whatever. And so when they say 15%, they're now discounting that note down to $85,000. So you're buying that note for $85,000 for 85 cents on the dollar, basically. And so you're paying 85. You're now the holder of a $100,000 note, and you're going to get $100,000. So you're going to get the spread between the 85 and the 100 plus all of the interest and the payments that are coming to you based on that. Is that correct?
No, this is just something. This is just an offer that they're offering. Period. To accredited investors. So that would be the difference. In most of my clients, they're not accredited. So I would want to have them to have access to interest like that, but it would have to go through me. So basically, I would create the fund, and then that would invest in a whole pool of money.
Right.
So whatever money I gather this month will be invested at the beginning of next month, and then we get a check.
Sure.
The income starts that month, but the monthly payments would come to me. I'm not going to offer them monthly payments. I may offer them some liquidity, like quarterly or something like that, but not monthly, because I just want to stay on top of things.
Yeah, I get what you're saying from how you're helping them. Go ahead, Carl.
I was going to say tread very carefully, because you've already set off quite a few alarm bells.
Yeah.
Like, that you're going to be very far outside the bounds of what the laws and security regulations
well, that's what I need help with. Yeah, that's what I need help with.
Yeah, unfortunately, I don't know anybody who's going to give you that advice for free.
Right.
Particularly because it's yeah, I mean, I'm speaking very generally here, right? Like, this doesn't, I am not giving you advice for your particular situation beyond what you've just suggested doing. I think is pretty firmly illegal, or at least in violation of most securities laws, state or federal, because you're talking about taking an accredited investment and basically reselling it to unaccredited people that you know are unaccredited. And I mean, that's just, it doesn't go like, in order to do that, you actually need to securitize it if you want to, or depending on where you live. And if you securitize it, then there needs to be all sorts of disclosures. and filings and legal expenses and, you know, ultimately, I don't even know if the person that's offering you the investment would be like the company that's offering you the promissory notes. Like, you probably would need more information than they typically give to someone that they're selling uh, high interest rate promissory notes to, right? I mean,
Right.
they're not contemplating that being resold. That's why they're calling it a promissory note. Um,
Mhm.
they're like they're doing that with the intent to avoid it being labeled a security. I'm pretty sure. Um,
Mhm.
but nonetheless, with when you where you sit, like you would be fine, right,
Mhm.
for to get your return on those notes. It's just the reselling it to unaccredited investors could be a problem. Um,
Even
there
if,
there there are there are ways you could make it work. Again, it's just like a very intensive process that um, requires like either a very good attorney and a and a strong budget for legal expenses.
yeah,
Um,
well, one attorney that I spoke with last week, he told me he starts at 25 grand. And when I try to explain to him what I was wanting to do, and they don't have to necessarily be unaccredited. I'm just, most of my clients are. Um,
sure,
he 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 put up a lot of roadblocks. So I was like, oh, well, maybe I need to rethink this or speak with somebody else that can help me get this done. I mean, because I feel like it can be done. To me, in my mind, it's simple, but I mean, the strategy is
yeah,
simple, but I guess everything else behind it, the mechanics, those are the things that I don't know. So, and that's what I need help with, because I want my clients to be able to enjoy better interest than what's offered at the bank.
sure,
And that's where most of my clients are coming from.
sure. Um, yeah, no, I understand all that. This is an example. Um, so I tend to be like a pretty libertarian person. I was gonna say, this is another example where, for those of us who take the time to educate ourselves and try to have the facts about situations, this is an instance where like the government, you know, does a lot to harm people in the name of looking out for their best interest. Um, because ultimately they make it practically impossible for the average everyday American that you run into on the street to do anything other than put their money in public markets. It's
Mhm.
just very difficult. If you don't have the right education or enough in your bank account, like there's no education requirement regarding this, right? This is all about how much money do you have, because the underlying sort of public policy behind it is like, oh well, we can't let uh, middle class whatever people like lose money to these bad unregulated investments. But in reality, they're not but necessarily any more risky or bad than what can happen in the public markets. I mean, like, ask my uncle who worked at WorldCom for 25 years, retired there. WorldCom was the greatest thing he'd ever known. Amazing company, millions of bucks all stowed in company stock because it was such a great company. Buy, yeah, it's all just poof, gone. So
Mhm.
you don't actually. I say that only to make the point, right? Like
Yeah.
under the auspices of protecting us, they keep people from being able to do certain things, um, and it actually um, it doesn't work out very well in the subjective. Like objectively, if you just hear that, like, well, we should protect people from potentially fraudulent investments. Not to say that this is, but that's the
Mhm.
policy, the public policy behind it, right? These kind of laws, because there's no reporting company. Like the company that's offering you these promissory notes is probably not a public company, so they don't have any kind of like financial disclosure requirements. They're not having to produce 10Ks and annual financial statements and SOC compliance reports or any of that stuff. So it's very difficult to do due diligence, and that'll be also a challenge regarding you trying to do these risk calculations. But if you're confident in it, it might just be a good investment. Like there is that, just personally, even if you can't resell it. But yeah, there's a lot, man. It's like it's more than this call could take. So.
Oh yeah,
Yeah.
absolutely. But the good news is between Ben and Carl, we've got some of the best compliance experts out there. And so Anthony, you're asking a good question, and just trust that between Carl and Ben, they will, if there's something you can do with that that's compliant, great. They'll get you that way. If if it's doomed from the start because the very instrument is non-compliant, then take their word for it and move on and find something else.
Okay.
And,
There's a couple different companies I'm looking at. One is a little bit better known, and they have a 9-month term paying 12.3%. So I just feel like, I don't know, I'm hungry to get this thing started, but I don't have all the information to
right.
put
Well,
it
Ben
all
will
together.
help you. Ben will ask the right questions. He'll certainly send you down a path of due diligence that'll get you a lot of questions answered, and you'll get your head around it for sure.
Yeah.
But just like as Carl's advising you there, just go slow, go careful. Step up and work with Ben to make sure that what you do is compliant from the get-go.
Yeah.
Okay. And if it's not compliant, then don't risk it. Just let it go and find something else. Any other thoughts, comments before we wrap it up? Frenchie, you've been kind of quiet tonight. Okay.
I know, I'm multitasking. That's why, because I'm trying to take care of troubleshoot a problem. So I'm listening.
Okay. Well, I just got to tell you, multitasking is a myth.
I know. Believe me, I know.
All right, guys. Well,
That is scientific fact.
Yeah, exactly. We'll let you go, and this will be rebroadcast in the community probably tomorrow morning. So if you want to go back and review it, it's there, and we'll encourage other people to go take a look at it as well. So have a good evening. Take care. Thanks, Carl. Appreciate you coming. Thanks, everybody else.
Thanks, Carl. Appreciate it.
And, look forward to seeing you again. Talk to you soon.
Bye, everybody.